Hi, welcome to valuationpodcast.com, a podcast and video series about all things related to business and valuation. My name is Melissa Gragg, and I provide divorce, mediation, and valuation services in St. Louis, Missouri. Today, we'll discuss business value drivers with John Warilow. He is the founder of the Value Builder System, which is a practice management software for business advisors. And he has a best-selling book called Built to Sell, Creating a Business That Can Thrive Without You. It was recognized by both Fortune and Inc. magazine as one of the best business books and has been translated into 12 languages. He's also written a few more books that we'll talk to you later about. But prior to founding the Value Builder System, he started and exited 4 different companies, including one acquired by a public company. He lives with his family in Toronto, and you can follow him by signing up at builttosell.com. He also has a podcast, and we'll talk more about that as well. How can, the reality is I can come in, you can come in, and we can value this business, right? And then we can say this business is worth $2 million. But when we go to market, like I said before, the market creates the price. So how do we get more than the $2 million?
Yeah, well, you're absolutely right. It's creating a bidding war. It's ensuring that you create a market for your company. And a market obviously has multiple people that are aware of it, that the information is transparent and can make a reasonable conclusion about what your business is worth. And when you create that marketplace, you can be sure that you got a fair price because you let multiple people look at it. And B, you can oftentimes get the value of your business increased just because more bidders, more value generally. I'm reminded of a guy I interviewed on Built Celebrity named Arik Levy, who built 2 businesses in the locker space. If you go to Whole Foods, there'll be like Amazon lockers. Mm-hmm. That sort of business model. In his case, he did it first in dry cleaning. And in his first business, he kind of didn't know what he was doing, and he decided to sell. He got an offer from one person and kind of didn't create a marketplace and said, okay, sure, I'll sell to you. They went through due diligence, and that acquirer retraded, as I was describing earlier. They lowered their price, and Arik kind of his nose was out of joint. He was like, well, maybe I won't sell. But then he'd already gone on to, figure out other things he wanted to go do. And so he decided to sell. Closing day comes, and that acquirer has not got the money to make the acquisition and says that you're going to have to finance us to buy this business. So basically, Arik agreed to take his money over time and risk over time that they would pay him back. So it's kind of the worst of both worlds, right? Retrading, seller financing, disaster in both ways. So Arik builds another business, and it's also in the locker space. This time he's installing these lockers in these sort of high-end Manhattan apartment buildings. And the second time, Arik says, you know what, I'm going to create a marketplace. I'm not going to just fall in love with the first guy or gal who kind of comes and knocking. He hires an M&A professional, a guy named Trip Wolf based in New York. And Trip creates the marketplace, right? He goes and shops the deal. He creates a teaser, and then he creates a sim, and he shops it to lots of different potential buyers. Starts with hundreds, ultimately gets down to a short list of 5 buyers who put in an offer, a letter of intent. And before Arik signs one of the letters, interestingly, the 5 were plus or minus 10% of one another. The introduction offers, in other words, the beginning offers were plus or minus 10%. But instead of just signing one and giving up his negotiating real leverage, Tripp's like, leave it with me, Arik. I'm going to see if we can squeeze these guys a little bit. And he played one off the other, off the other, off the other, off the other, and ultimately got the price of the business up by 300%. In other words, 3 times more than those original offers were coalescing around. It's a story that has always left me with chills, because I realized that this is where business owners leave tremendous amounts of money on the table. If they don't create a marketplace for their business, they can leave literally millions of dollars on the table, and they will never know. And we talked about, the guy rocking in the rocking chair lemonade, regretting his decision to sell. One of the reasons they regret is they wonder all of a sudden out of the blue, oh my gosh, did I leave money on the table? I took the first offer I got. I was approached. I never created a marketplace. Creating a marketplace, you may not get acquirers to increase the value that they're willing to pay, but you will win nonetheless, because you will get the peace of mind to know that you did get a fair price for your business, and that is priceless. Mm-hmm. So I think creating this marketplace is just, it's a really important part of selling a company.